Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, big jobs report just came out this morning for the month of May. Non-farm payrolls, new jobs report much better than expected. We're starting to see the odds of that rate cut in September drop down after the odds had increased during the past few weeks because we had some weakening economic data. So the market is all over the place right now. Also, on the labor market front, if you look at those job openings, right, unfilled job postings, those continue to fall and are at their lowest level since 2021. That's going to be something to watch as well. Looking at the stock market, valuations obviously somewhat stretched, but we're seeing a lot of that in those big cap tech names. If you look at other areas of the market, valuations are not that high right now. So let's talk about the May jobs report. 272,000 new jobs from this non-farm payrolls report. That is much larger than the 180,000 jobs expected from that same report. We had wage growth that continues to increase. Remember, those wages are increasing at the same pace, in some cases, not more than the relatively high inflation right now. So that's why we're not seeing an economic contraction. That's why consumer spending continues to be very strong. If you look at the household survey, the other part of this monthly jobs report where they ask households, it's sitting at the unemployment rate, not high, but jumped from 3.9 to 4%. That is somewhat notable because that's the first time it has been at 4% and not below 4% in more than 2 years. So something to keep an eye on. If you look at underlying causes of that, more people from the survey lost their jobs last month and fewer people entered the workforce. So you saw a slight uptick in that. All of this means the Fed is not going to be in a hurry to cut rates. Whether it's September or November, it's hard to tell right now. Most expect that, as I do, that the Fed's going to at least cut one time this year, but it's going to be very data dependent and time will tell. Now, the other part of the coin is the US job openings rate. You'll hear this referred to as the JOLTS survey sometimes as well. That is at 4.8%. That's well off the peak of more than 7% back in during the past couple of years. Now, why is this important? Well, we had massive amounts of supply, right? A lot of jobs and not as much demand. So that's one of the reasons the labor market's been so strong. And we have been saying for some time, you're going to need to see these job openings come down significantly before you start to see any kind of labor market tightening that might force the Fed's hand in cutting rates earlier. I make note of about a year ago, some comments from Fed Governor Waller, where some of the research team discussed that if we get a job opening rate below 4.5%, right, just below this 4.8% it's currently at, that will likely lead to a significant increase in the unemployment rate, right? It's supply and demand. More jobs there are and less people looking for jobs, you're going to have strong increases in wages to attract current employees or to attract new employees to fill jobs. As the supply decreases and the demand stays the same or demand increases, you're going to see that imbalance come, and that's where you could start to see less wage growth. You could start to see more layoffs and the unemployment rate jump up. So something to keep an eye on with regard to the job openings rate. This is something that's unfolding that perhaps would be the first stage of eventual some pressure on the labor market that the Fed and the market's been kind of waiting for some time. Now, markets, S&P 500 just reached an all-time high. Almost no other stock market indexes did. Everything else is trading at or near all-time highs. NASDAQ, the tech-heavy NASDAQ did. So prices are very strong right now. If you look at valuations, right, historical valuations are more stretched, but if you look at on the chart here, it says the NTM, that means next 12 months. So that's forward looking based on analyst estimates, 12-month forward price to earnings ratio. The higher that is, the higher current prices are relative to expected earnings for companies, right? Overvalued. This breaks it down into different categories. So we look at the S&P 500 in the red. You can see the next 12 months price to earnings ratio of around 21. if you look at the S&P 500 median next 12 months price to earnings ratio, right? Forward 12 months price to earnings ratio, that is at 18. Now, the median is simply, right, not quite the average where outliers can skew it, but if you line up all the companies from 1 to 500, it's going to be, right, that company at 250, the company right in the middle there. And that's at a valuation of 18. And on the flip side, on the extreme, if you take those top 5 market caps, right, they just reached 28% of the S&P 500. The 5 largest companies in the S&P 500 index consist of 28% of the overall index. That is very large. And if you look at the impact they're having, you can see that top 5 median at 31.4 next 12 months price to earnings ratio. So those big cap stocks are overvalued relative to the earnings that they're producing and expected to earn over the next 12 months. But other parts of the markets aren't quite as expensive. This is not a frothy market where everybody's buying everything indiscriminately. That's something to keep an eye on. Now, everybody's talking about someone named Keith Gill, famously known as Roaring Kitty. And I was going to touch on that today, but I thought maybe I would highlight something from maybe a little bit more important. Supreme Court Justice Clarence Thomas has been on the bench for more than 2 decades, and they've been doing some little investigations, and they've been uncovering quite a bit of gifts that Mr. Thomas has been accepting over the past couple decades. Potential at minimum, probably 2.4 million up to maybe north of $4 million in gifts that he received. If you take all the other justices combined during those times, that was nearly 10 times more. Most of this came from a billionaire real estate investor, Harlan Crow, and it included such things as luxury trips, use of his yacht, even paying the tuition of Thomas's grandnephew that he essentially was raising as his own and adopted from the age of 6. That billionaire Republican donor Crow paid for his tuition to private boarding schools several years in a row. So most of that was not reported by Thomas. There's some discrepancy about whether he should or not. Was a shock to me. I can't believe Supreme Court justices don't have to report certain gifts, but I think they're going to work through that, investigate. I don't know if Thomas is going to be leaving the court anytime soon, but it's going to be something to keep an eye on, just with regard to the oversight and regulation around those gifts in the Supreme Court. This was a little bit shocking for me, and I hope they clean that up quick, because that can have some scary implications. With that, I want to thank everyone for watching, and I'll see you next time.